It's been called the Great Resignation. 55% of Americans plan to seek new jobs in the coming year. Here's another headline. An astonishing 95% of workers are thinking about quitting their jobs. If these headlines resonate with you and you're wondering how you can afford to quit your job and finally start living life on your own terms, I think you'll find this video valuable. If you want to quit your job and live off dividends, I'm going to explore the fastest way to make it happen. You don't have to wait until you're 60 years old to experience financial freedom, and you most definitely do not need $1 million either. Whether you just want to quit your job and travel, or you just need some financial breathing space to start your dream business, dividends can help pay your bills so that you can focus on what really matters to you. Most people wrongly assume you need millions of dollars to earn enough dividends to live comfortably. This is because most people think that dividends only come from stocks of big companies where they pay out 1 to 2% a year, which is next to nothing. For instance, we can look at great quality companies like Johnson & Johnson. It creates thousands of products used every day around the world and earns billions of dollars in profit each year. But even though it has grown its dividend for 59 consecutive years, it only pays out a 2.6% dividend yield, and that hasn't changed much in the last 10 years. So if you want to live off dividends from Johnson & Johnson and you only need, say, $30,000 to survive, at a 2.6% yield, you would still need to have $1.1 million worth of J&J stock to make it happen. So it'll take the average person decades to save up that much, and J&J isn't an outlier either. If you look across the broader market, such as the S&P 500, the most popular ETF that tracks that index pays a yield of only 1.23%. In fact, companies that do pay much higher dividends happen to be the outliers in today's market. There's AbbVie, the pharmaceutical giant, a favorite among dividend investors that currently pays a 4.9% yield. There's ExxonMobil, which pays 5.4%. There's AT&T, which currently pays a 8% dividend, but to the disappointment of many dividend investors, it's going to be cut in half sometime next year. The bottom line is, if you want to build a dividend portfolio with high-yielding stocks, in my opinion, there just aren't a lot of high-yielding companies to build a robust, diversified portfolio, at least with yields high enough to be able to live off dividends fast. So rather than trying to live off dividends using traditional dividend stocks and ETFs, you're better off investing in what are called covered call ETFs. These ETFs shine where traditional dividend stocks and ETFs fall short. They're designed to generate yields as high as 12% and almost always pay monthly dividends. So what are these ETFs exactly, and how do they pull this off? Well, to understand them, you need to know a bit about options trading. Covered calls are a type of options contract that can be bought or sold. When you own a stock or an ETF, you can enter into a covered call contract to sell your holdings to a buyer if the stock or ETF price rises to a specific target. By agreeing to this contract, you as the seller get paid a fee called a premium that you keep no matter what happens to the price. So what covered call ETFs do is they hold a basket of stocks like any index fund and sell these contracts every week or every month, and the premium from those is how these ETFs generate such high yields. One of the most popular covered call ETF is QYLD, the Global X Nasdaq 100 covered call ETF. This ETF pays around a 12% dividend yield, or nearly 1% every month. So for every $10,000 invested, you earn an average $100 each month in dividends. QYLD tracks the top 100 companies on the Nasdaq index and sells covered calls on its entire holdings. Most of the dividend it pays out does not depend on the underlying company's ability to pay their dividend. Again, it's funded mostly by the options premiums. This means it's impossible to experience a dividend cut per se, and the dividend will keep up with inflation because options premiums are paid in nominal dollars like any business transaction. However, there are 3 downsides that you need to be aware of. One downside is your dividends are not going to be consistent every month. As shown here from 2019, the dividends received from each share will fluctuate each month around the 20-cent range, and that is because options premiums increase or decrease in any given month, which is driven by market volatility. Second, the dividends are not considered qualified dividends, so you don't get taxed at the lower capital gains rates that you typically would if you're holding qualifying dividends like say from Johnson & Johnson. However, the biggest downside to QYLD and other covered call ETFs is that their price is unlikely to appreciate as much as the broader market. QYLD is an extreme example where over the past 8 years since inception, your initial investment would have lost just under 9% in value. Even if we take into account any dividend reinvestment, when we compare a $10,000 investment since 2013, you can see that an S&P 500 index fund would have grown to $23,200, while QYLD would have grown only to $17,800. So obviously there is a trade-off between income and price appreciation. You can see here that the income from QYLD dominates any dividend from the S&P 500, but as the annual returns show, the S&P 500 still comes out ahead due to capital gains. So you have to be comfortable with the fact that by investing into QYLD, you're giving up future price appreciation for income today. However, by incorporating QYLD into a high-yield dividend portfolio with other ETFs, you can fine-tune that trade-off for your specific needs. And even though a 12% yield sounds amazing, I don't recommend investing all your money into only QYLD. Instead, I'm going to introduce you to a few other covered call ETFs and walk you through step-by-step using free tools like Portfolio Visualizer and M1 Finance on how to construct your own portfolio properly with the core satellite strategy. But before we do, if you're getting any value from this video, all I ask in return is that you hit that like button, and while you're down there, consider opening an account with M1 Finance to start your dividend portfolio. M1 is an investing platform that is commission-free, no minimum deposits, there's no cost to use the basic service. And in a moment, I'm going to show you how M1 is built for passive dividend investing from the ground up. Also, you can get a cash bonus of up to $500 for opening a new M1 account and making a deposit. So check it out by using a link in the description below. To construct a simple high dividend portfolio, I'm going to use QYLD and two other covered call ETFs for a not so obvious reason. Those are JEPI and NUSI, and I'll dive deeper into them in a moment. But first, these offer attractive dividend yields of 7% and 7.6% respectively. But it's not because of the high yields that I want to include them. Instead, it's because of their lower correlation to each other and QYLD. Portfolio Visualizer has a tool that allows you to see the correlation between different assets, and this is really important in building a quality portfolio because low correlation ultimately means you have true diversification and thereby lower risk. Now, I talk about this in much greater detail in this video on how to build the best dividend portfolio. So be sure to check it out if you want to learn more. You can see that QYLD and JEPI have a 0.78 correlation, QYLD and NUSI have a 0.56 correlation, and NUSI and JEPI have a 0.36 correlation. A value of 1 means two assets are perfectly correlated, and 0 means there's no correlation. So this tells me that QYLD and JEPI move together more closely than NUSI. NUSI is the least correlated between the three, and that makes it a good candidate for our core holding because in the core satellite strategy for building a portfolio, your core holdings is meant to anchor your portfolio so that your overall volatility remains low, and it's usually more diversified compared to the satellite holdings. If we look at the 30-day volatility range for each ETF, QYLD is the most volatile, while NUSI and JEPI are pretty low. But there's another important reason why I think NUSI makes a good core holding, and it has to do with how the ETF itself works. NUSI is the nationwide risk managed income ETF. This sells covered call options off the Nasdaq 100 just like QYLD, except it also buys put options. By buying put options, it basically puts a floor on its losses. The difference in the premium received from the call options and premium paid for the put option is a net credit or a profit. This way, the ETF generates income and provides downside protection, which makes it a solid core holding. But in trying to balance income with price appreciation, NUSI has the same problem as QYLD. It doesn't provide much price appreciation because covered calls essentially limit price gains. This is where JPI comes in and balances out the portfolio because it's not directly selling covered calls like NUSI or QYLD, so there's no ceiling on price appreciation. So while NUSI is the core holding and QYLD is what you would call a satellite holding specifically to boost our portfolio yield, JEPI, as you would have guessed, is going to provide the price appreciation. JEPI is the JP Morgan Equity Premium Income ETF. This fund invests about 80% of its assets in many companies in the S&P 500, but also other companies that have low volatility. But the key is there is no covered calls being written on these. Because of this, you can see here since its inception that it has beaten NUSI and QYLD by a wide margin. Now the 7% dividend comes from the remaining 20% of assets invested in equity-linked notes, or ELNs. It's these ELNs that provide the recurring income from selling call options. Now, I've already covered JEPI and its ELNs in depth in this video right here, and I also go deeper into QYLD and NUSI, so be sure to check it out if you want to learn more. So with a basic grasp of these three ETFs, I'm going to turn to Portfolio Visualizer to determine how to allocate these in our simple portfolio. You can use this to backtest how your allocation would have performed, as well as calculate your portfolio yield, and we'll take that allocation to M1 Finance to build our actual portfolio. So here on the menu selections, I'm not too concerned about these for our purposes, so I'm going to leave it as is with our initial contribution of $10,000, and yes to dividend reinvesting here, and yes for display income. Here, I'm going to build 3 different portfolios, each with a different allocation for our 3 ETFs. This is where you can fine-tune your portfolio for your needs. I have the ETFs listed on the left, and for portfolio 1, I have NUSI making up 50% and the 2 other ETFs split evenly. So this one is evenly balanced for income and appreciation. Portfolio 2 is weighted more towards income with 50% allocated to QYLD and only 20% for JEPI. And portfolio number 3 is an inverse of that with 50% allocated to JEPI for price appreciation and 20% for QYLD. Now, I already ran this analysis, and so if we scroll down on the summary tab, you can check and confirm our allocations are what we wanted. But I want to point out that we are only seeing data from June 2020 and onwards because JEPI is a very new ETF and there's not that much data. So if you want to keep that in mind as we look at some more of these numbers. So further below, it shows the portfolio returns. And if you recall, this is with dividends reinvested. All 3 grew our initial $10,000 investment to around $12,500 to $12,900, with portfolio number 3 in orange giving us the highest result and a compound annual growth rate of 19.8%. Portfolio 2 came in second with 18.9%. Obviously, we aren't going to read too much into these results. It's too short of a time period to make any judgments other than that our portfolios are performing as expected. Okay, now I want to take a look at the portfolio yields. Based on the trailing 12 months, the dividend yield for portfolio 1 is 8.5%, and the weighted average fee we are paying is 0.58%. For portfolio 2 is giving us a yield of 9.4%, which is as expected with basically the same fee. And finally, portfolio 3 has a slightly lower fee and dividend yield, which comes in at 8.2%. So from here, you need to decide what portfolio allocation is right for you, or you could start from scratch with your own ETFs and run through this process as you see fit. But let's just say you really like portfolio number 2 and you really want that income and you want to build that portfolio and start investing or move money into it. So let's hop over to M1 Finance and make it happen. Once you create your M1 Finance account, you'll go to the research page. From here, you'll go to My Pies, create new pie, and you'll search for your first fund. Let's go ahead and find NUSI. All right, everything looks good. We have the right ETF, and let's go ahead and add it to the basket. Okay, next we'll look for QYLD. Here we go. Again, everything looks pretty good as is. The yield is showing as 10.7%, and depending on which website you are looking at, some sites calculate the yield differently. So you should take a look at the actual dividend payouts if you have any concerns about this. We'll go ahead and add this to the basket. And lastly, we're looking for JEPI. And again, this looks like what we've been looking for. And again, dividend is slightly lower than what other sites are showing, but we'll go ahead and add it to the basket for now. Okay, now we go to add. All right, now our new portfolio is created. So M1 calls portfolios pies, and essentially it's showing you the asset allocation here by share. And that is arguably the most important attribute for a quality portfolio for passive investors. Now let's go to edit, and here we will adjust the allocations for what we wanted. Then we'll add a name to the pie. Let's just call it covered call dividend portfolio, and then save. And that's it. That's all there is to it to building a portfolio in M1 Finance. Now, when you start adding money into the portfolio, the money will be invested automatically according to your allocation. And the cool thing is it will maintain that allocation or as close to it as possible as you add more money. So if JPI performs really well and starts making up a bigger share of the pie, M1 will automatically take any new money added and invest it into QYLD or NUSI to keep the asset allocations consistent. So that's it, guys. I hope you found this video helpful. Thanks for watching, and I'll see you guys on the next video.